Hello, everybody, and welcome to the Tortoise channel. And what a week this one has been. So I'm recording this on February the 6th. And yeah, if you are an investor, then it's for sure. I mean, you have felt the volatility over the last several trading sessions with the markets sharply lower. I decided to record this video, and I wanted to be different. All right. So many people across social media post videos on stocks, and I do that myself, and it's awesome because it's always nice to give you insights into my investment framework and to share potential ideas that might suit your investment needs. Okay, but I want to discuss psychology, yeah, in this video. And the reason is because I continue to see a lot of panic across the board, and especially within my own community. So people understandably ask me these questions, right? Because we are humans. I'm human as well. And so they ask, Ed, what do you think? I mean, about the sell-off. Do you think it's going to continue? Do you think I should sell my positions? Do you think I should be more like on cash? And it's just amazing, right? And it goes to show that no matter how long people have been doing this, right? So the markets have always existed for the last several decades, for the last many decades, and many of these people that I coach, they know very well that these are the times to take advantage of opportunities, right? But still, it's so difficult for the vast majority of people to pull the trigger when the time comes, right? And that's why I decided to create this video, and hopefully it will help every single one of you who are watching this video, many of whom have subscribed to the channel as well, okay? And so for those of you who don't know, I have a degree in psychology. So yes, I went on to study financial analysis and business management. But a part what really helped me, guys, as an investor is not understanding like basic accounting metrics, right? In the financial statements that, in my opinion, is not that difficult, because we are always looking at the same numbers in same financial terms, right? So it's more like rinse and repeat. But what really made me what really allowed me to compound money at above 20% for years is psychology and the ability to make sound investment decisions while removing emotions from the equation. All right. And so I will show you, and I've already discussed this at length in previous videos. And in fact, I will refer some of those videos to you guys right now so you can delve deeper into them. But the goal is to provide some strategies in very broad, yeah, in a very broad way, because I've discussed them at length. But these strategies, right, will allow you to actually weather that volatility and actually be comfortable buying more when the companies that you own become cheaper. All right. So let's jump right into the video. And number one, I want to talk about one video in particular that I put out a few weeks ago. And the name of the video on YouTube, which I also shared in our Skool community, was "It's not the market, it's actually your mind, why investors underperform." This is the name of the YouTube video. So just to go back to a few videos, and you can see that in that video, I discuss. So I walk you guys through a PDF that I put together for our community members called "The Invisible Enemies of Long-Term Investing." This is a guide to cognitive biases, and it covers everything from loss aversion, right, to recency bias, confirmation bias, anchoring bias, herd mentality, FOMO, right? FOMO, disposition effect. Altogether, I discuss 15 cognitive biases. In my opinion, these are the most important ones that you guys should understand. And once you understand them, right? Once you understand them, and I provide examples, right? I discuss what they are, the investor, how the investor behaves while not being aware of each of these cognitive biases and give. So I give you an example. So you guys, the first thing that you need to do is to be aware of our cognitive biases and why we behave the way we do when we see things, when you see stocks going up and everybody gets euphoric, right? And why we become so emotional, right? And we just can't wait to sell when the markets come down and fear spreads in. And of course we are seeing quite a lot of fear right now with the Nasdaq, for example, only down 7% from its all-time highs. So if I show you right here, let me just minimize this again. For those of you watching this channel for the first time, I use eToro only for educational purposes, so to right, because it's easier to navigate the charts. But I use interactive brokers to execute all of my personal transactions, right? And so you can see the markets are, by the way, up today, right? It's going to be very interesting to see what will happen once the U.S. markets open at 2 p.m. London time. Will the buying continue, or will it stall, especially into the close of today's trading day? I'm very looking forward to see that. But you can see that if we from the all-time high, right, set not that long ago to the most recent low, this thing was only down 7.86%, right? And now, because it's up, it's only down about 6%, and I still see so many people panicking. So that tells me a few things. And that's what I want to address again in today's video. How can you mitigate these emotional reactions that we all face, no matter how seasoned we are as an investors? And I've been doing this for a few years now, but still, nobody likes to see the portfolio bleeding, right? It doesn't matter if you are doing this for a few months, for a few years, for decades. Nobody likes to see the portfolio down 50, 30%. Man, I hope you are not down 50%. If your whole portfolio is down 50%, then you are not doing things that you should be doing, right? That's not good. Yes, some positions in your portfolio can be down 30, 40%, but the whole portfolio, I mean, come on, guys. I mean, just use the framework that we've been sharing so openly with you, and you won't be doing those mistakes. Okay? How can you mitigate that emotional reaction? Number one, you have to understand what you own. If you don't understand what you own, you will panic. So the more due diligence you do, right? The more due diligence you do on a given company, the more comfortable you will be, not only weathering the storm, but also buying more of that company, right? Every time it becomes cheaper. Because as an investor, as a long-term investor, as a net buyer of stocks for the next 30, 40 years, and I know that many of you guys watching this channel are probably in your 20s or 30s, right? Then you should welcome lower prices. I love it. It's fantastic. We want lower prices because we want to buy, to scoop up bargains. It's not nice to see the indices going up every single week, right? It's very difficult, especially if you are like me and if you want to buy, you want the best combination of quality and cheapness, you will love to see lower prices. And so understand what you own very well. And I can give you a very good example. PayPal is probably the best example in my portfolio. Not probably, but I don't know. Let me give you another one. Alibaba, for example, right? I can give you LVMH, which at one point the stock was down 50% and people were panicking. And now, right, in Alibaba, people were calling Alibaba an investable, yeah. And now we have PayPal. And is it nice to see that PayPal is down 20% ever since they reported earnings? Of course not, right? I'm not selling because I understand the company. I still think the company has a moat. I have multiple exits, right? Oh, but it's a payment company. No, they are a payment company, but they are transitioning into an e-commerce company as well, right? So they are in the buy now, pay later space. They are in the crypto space. They are in agentic e-commerce. You have multiple exits here, right? And so, in addition to understand the company very well, that's one thing that you will have to do. You have to buy it with a margin of safety, because guys, no matter, look, this is where I differ from many other investors, and many of whom I have brought to the channel, right? So you saw my interviews with them, and and some of them are close friends and all of that. But I think that you can maximize your returns when you buy something with a big margin of safety, right? And the margin of safety will protect you both on the downside, because it will cushion your downside, right? But it will also maximize your upside once the market returns the company back to its fair value, right? And so you want that combination of quality, but at the same time cheapness. And so here are two ways again that you can control your emotions. Understand what you own very well, right? Number two, buy with a margin of safety. Number two, don't buy any shitty company. Buy high quality companies, right? I don't care if it's Amazon, if it's Google. Every single great company goes through periods of uncertainty, and I promise you this, the stock will crash. Okay? It may be once or two times in the lifetime of the company, but it will crash. And that's why you need to have a watch list of 20, 30 companies, because some of them will hit those price targets. And when they do, will you have the courage, the guts to pull the trigger when everybody is running to the exits, right? And if you do, you won't be average. You will be above average, right? You will be the tortoise type of investor. Look at the average investor, right? I share this many times with people that I'm clients and partners, and it's just staggering. Look at that. 3.6% annualized returns for the average investor from 2002 through 2021. That is staggering. Why? As Warren Buffett rightly said, the stock market is a device to transfer wealth from the impatient to the patient. The costs, the biggest costs of achieving the above average returns over time is volatility. Do you have what it takes to handle it? Right? And many of us share videos on companies, and then we sell when things when the company for some reason stalls, right? And we forget the fact that companies operate in a dynamic environment. They are made of people, right? People are emotional. Boards make decisions. Sometimes those decisions are flawed, and so it's perfectly natural for a company to go through periods of uncertainty. But as long as the story remains intact and there is value there, right? You can, and you only need to do this for like a few handful of companies, and you will be set up. This will set you up nicely for financial freedom, right? And so that's why I keep pounding the table on this, guys, because it's just so important. At the end of the day, I can show you how to read a balance sheet, a financial statement, right? So financial statements, but will you have the courage to do it? Most people already know about revenues, that revenues going up are good. Okay, yeah, the companies are selling more of their stuff. That's a good thing, yes. Uh, but the emotional aspect of the markets is what really sets you apart from the average. And that's why I'm creating this video, because I don't want any of us to be average. I want us to be above average, right? And you are not going to be able to do that unless you are buying when other people are selling and selling when other people are buying, as Warren Buffett has taught us over time. And so I share this great Peter Lynch quote on our WhatsApp community, on our WhatsApp group, right? WhatsApp community group. And I'm sharing this with you here because I really think it speaks volumes of all what we are seeing right now in how investors should behave. So let me go here. Excuse me, it's not this that I want to show you. This is the community, right? So this Peter Lynch, look at that. The most important organ in the body, as far as the stock market is concerned, is the guts, not the head. Anyone can acquire the know-how for analyzing stocks. Anyone can acquire the know-how for analyzing stocks. But will you have the stomach, right? Will you have the guts? And part of what I do with my clients I every single day, with each passing day, I remember that this is so important that it actually warrants me doing more of these videos. Just because I think I can definitely bring value to the table in that regard, because I studied psychology. I understand um, I understand how people behave, and I understand how you can take advantage of those situations. And so, yeah, this is what I wanted to discuss here again, guys. Okay. So let me know if you want me to put out more videos, more content regarding psychology and some of the things that I learned over the years that made me a better investor. Uh, because you have to understand yourself, and you may very well come to the conclusion that individual that stock picking is not for you. And if that is the case, perfectly fine. At least you are brave enough to acknowledge it. You acknowledge it. It's like going abroad. It's not for everybody. I've been living in London for many years. Many people leave Portugal, they stay a few years abroad, and then they can't wait to go back home, and they go back home because they don't adjust, they don't adapt, and that's okay. It doesn't mean they are weak. It simply means they are not suited for it, right? They are not, so they are not built that way, but they have all the strengths, right? And so just put your money in the index fund, and if you have 20, 30 a 30-year investment horizon, I think chances are you will achieve your 9% 10% per year over the very long term. Okay, but this channel is for people who actually want to beat the market over time, in compound money at 15, 20% per year. And we are doing plus 20% plus per year. And you can see I'm sharing the compound growth calculator that I share with our clients as well with you. You can see what that does to your money. For example, if you start with 1K, if you invest 10K in your first year at the beginning of the first year, and then you have another 10K at the beginning of the second year, and another 10K at the beginning of the third year, right, in fourth year, look what happens when you compound money at, say, 20% per year. You can see the difference that this makes over time, and compare that with just 9% for the S&P, which is the average for the last decades, right, for the last 70 years, and you can see the staggering difference right here. Look at that. Okay, this is the price of that you pay for volatility, and it's not for everybody, right? But because you are watching this, I assume you want to be a better investor. And all of you guys that are subscribed to this channel want to become better investors. I know, based on your feedback. And I want to become a better investor. We can always improve and learn from our mistakes. And that's why I want to make sure that we are completely aligned here. All right. Awesome, guys. So if you like the video, just smash the like button. It really helps the channel. And share it with people that you think can benefit from it. And let's be the tortoise, not the hare. We don't want to get there faster. We want to get there regardless. And that mindset is really key here, right? Because what good is get there like fast if then we're gonna destroy our account, if then we are not going to what we are doing is not sustainable, right? No, this is a long term gain. and we want to compound money uh, no matter what the market is doing, whether it's going up or going down. And so this is very important to have a sound framework and to understand your emotions. So guys, let me know, smash the like button. Have a great rest of your Friday and have a great weekend ahead.